Hello everybody, welcome to the first quarter 2026 economic update call. My name is Greg Sweeney. We have a number of topics on the list today. Everything, most of them current events, housing, inflation, Federal Reserve, employment, trade and trade deficits, and federal deficits and debt. First on the agenda though is housing costs, and I thought you might enjoy a kind of a deeper dive into the housing topic. A lot of news information about how housing is expensive. I thought it would be interesting to go back and do a comparison to 40 years ago. The average home price was $82,800. Average household income at the time, $23,620. If we look at that metric, the price of the house compared to the average household income, the cost of the house was 3.5 times income. Fast forward to 2025, 40 years later, the average home price is $416,900. Average household income is $83,150. And today the price of a house is 5 times income. Now, if we stop the comparison there, we would say that housing is way, way more expensive. But if we do a little bit of a deeper dive into that topic and we look now at financing costs for housing, we would see that interest rates for a mortgage loan back in 1985 was 13%. If a person put 10% down on their house, the payment for that house as a percentage of income was almost 42%. Today, interest costs are 6.25%. With 10% down on the house, that payment as a percentage of average household income is 33%. So after financing costs, the price of the house as a percentage of income is significantly less than it was 40 years ago. But I don't think it's fair to end the conversation there either. The reason I say that is because if we take another step and go a little bit deeper, in 1985, the average house built was 1,785 square feet. As I mentioned, it was $82,800 on average, which was a cost per square foot of $46.39. If I adjust that for inflation, 40 years forward, today that per square foot cost would be $139.46 a square foot, and the house would be roughly $250,000. The difference is, though, the houses being built today really aren't what I would consider starter homes. Instead of 1,700 square feet like they were 40 years ago, the average home being built is 2,400 square feet. At an average price, like I said, of $416,900, that's a cost per square foot of $173.71 per square foot, compared to the inflation-adjusted number that I gave you from 1985 of $139.46 a square foot. So then you might be asking, hey Greg, that's still $34 a square foot difference. And you are exactly right, which is why we're going to go even one step further into this comparison. And I'm going to compare houses built in 1985 to houses built today. As I mentioned, the house 40 years ago was 1,785 square feet. It had 8-foot ceilings. Some of you on this call might remember this. Others might be too young to remember it, but the flooring was a roll-out linoleum or vinyl flooring. Inexpensive way to put flooring out. Laminate countertops, melamine cabinets, which are just basically a material covering pressboard cabinets, 2-car garages, and 2x4 construction. Today, as I mentioned, those houses are about 600 square feet larger. First of all, 2,400 square feet. They have vaulted ceilings instead of 8-foot ceilings, luxury plank flooring or maybe some sort of maple or oak flooring, marble or granite countertops, hardwood cabinets, 3-car garage, 2x6 construction, right? The houses aren't even comparable to what they were 40 years ago. I would propose that we could build a house today with the similar characteristics that existed in 1985 and make them very price competitive. But with all these amenities in the house, there's a cost to putting in vaulted ceilings and 3-car garages and maple hardwood cabinets and marble and granite countertops and things like that. And the average amenity cost per square foot that I came up with was about $23 a square foot. And then regulations, of course, have changed, environmental and energy regulations. And that was another $13.42. That's the 2x6 construction on gas windows and things like that. After adjusting for amenities and environmental regulations, I come up with an additional $36.34. And if you remember from the last page, I was just looking to justify $34. So all in, we can account for this but we could probably make houses less expensive if we went back to the vinyl flooring, laminate countertops, melamine cabinets, 2-car garages, and much, much smaller in size. I mean, is a 2,400 square foot house really a first-time home buyer size house, right? 1,700 is probably way closer, and actually pretty generous. I go back to my first house, which roughly was 40 years ago. I mean, it was 1,500 square foot, 3 bedrooms, and I thought, wow, this is great. I can't imagine my first house being 2,400 square foot. So anyway, there's a deeper dive into housing. I'm about 6 minutes into this call. I spent more time on housing than I wanted to, but I hope that provided a much better perspective of what might be going on in the housing market. Ask yourselves, if we went back to a house that was built like it was in 1985, would I accept a house that had linoleum flooring, laminate countertops, and melamine cabinets? Inflation. A lot of pressure in the marketplace from inflation. Now, on one hand, we have economists celebrating that inflation is low compared to where it was a few years ago. That's exactly right. But consumers don't really feel the same way. Why is that? There's a graph here that shows us exactly what's going on. The red line on the graph and the left scale illustrates how consumers look at inflation, right? And inflation is a cumulative process. The prices just keep going up and up and up at the rate of inflation. So if we look at 5 years ago, a basket of goods that cost us $100 has gone up to about $128 today. That's what it costs us today. At the same time, inflation has been trending around 3%, give or take a little bit, for the last, about 2.5 years. So you have economists cheering that inflation is low, but consumers lamenting the fact that prices are high. And it's because of that cumulative effect. Now, a lot of that cumulative effect happened in the wake of the pandemic, where we were experiencing 5 all the way up to 9% inflation rates, and the price of that basket of goods went up fairly precipitously, but it's still going up at the rate of about 3%. That's not very comforting for consumers, because that $128 basket of goods today just means it's going to be $130 at the end of the year. That's what a 3% inflation rate environment looks like. Unfortunately, it's really hard to get those prices to go down. As I mentioned, inflation is cumulative. So even if we get inflation down to 2%, the economists would be cheering even more. But the reality of it is prices are still going up at the rate of about 2%. So that $130 basket of goods at the end of this year would be $133 at the end of 2027. Okay. So that's hopefully a visual that shows you, at the same time, I should also mention that cumulatively prices are up about 28%, but wages are only up about 24, 25%. So they're about 3 and change percent behind the increase in inflation. So that adds to the consumer's perspective that cost of living is very expensive today. There's a lot of discussion about the Federal Reserve getting inflation, targeting inflation around that 2% level. I thought you'd be interested to see a history of inflation a little bit more long term. This data goes back to 1968. So almost, what is that? No, long time. 70 years? 60 years, sorry. Long-term average inflation during that time period is 4%. We're currently trending right around 3, give or take. The latest number I had on here was 2.7. And the green line on this graph is showing the Federal Reserve trying to target that 2% inflation rate. There's not a lot of history of a 2% inflation rate. Most of the 2% inflation rate that we saw on a historical basis happened in the wake of the great financial crisis, the housing crisis, whatever you want to call it, in 2009. That is most of the period where we saw inflation rate below 2%. Prior to that, we touch on it every here and there, but it's not a consistent situation having inflation, at or around that 2% level. So anywhere in between that line is probably what I would call a normal inflationary environment. 2.7%, somewhere around 3%, give or take, is where we think that we are headed moving forward, is fairly normal, right? So I don't have any, super news that I think the Fed is going to be successful about getting inflation back down to 2%. I think we're back into that historical normal range, 3%, give or take, from an inflationary standpoint. I'm going to show you the 2-year Treasury yield, and you might be saying, Greg, what does the 2-year Treasury yield have to do with anything? The 2-year Treasury kind of gives us an idea of where the Federal Reserve is headed when they talk about lowering interest rates, right? A lot of discussion about the Federal Reserve, a lot of pressure coming from the administration to have Jerome Powell, who is the chair of the Federal Reserve, lower short-term interest rates. The idea is that if short-term interest rates go lower, mortgage rates go lower, housing gets more affordable, credit card borrowing goes down. All that is great news, except for the fact that long-term interest rates don't necessarily track short-term interest rates. So even if the Federal Reserve does lower short-term interest rates, long-term interest rates could potentially go higher, driving mortgage rates higher, driving credit card rates higher, and things like that. I'm showing you the two-year Treasury because there's a pretty strong consistency between where the two-year Treasury yield is and where the Federal Reserve probably ends up setting their interest rates. So we can see that the two-year Treasury right now is around 3.5%. I'm going to show you another graph that shows the two-year Treasury versus the Fed funds rate. We can see that the two-year Treasury and the Fed funds rate tracks very closely over time. Yes, there are some gaps in there as the two-year Treasury goes down or Fed funds goes down and two-year Treasuries lag. But for all practical purposes, if you're not that concerned about the exact timing, the two-year Treasury gives us a good idea of where the Federal Reserve is headed. The two-year Treasury suggests that the Federal Reserve is headed to a Fed funds rate of about 3.5%. 3.5% to 3.75%, the Federal Reserve gives us a window of 0.25%, is exactly where they are right now. 3.5 being the low end of the Fed funds bound, 3.75 being the high end. They're actually trading at about 3.56% is where the actual Fed funds are trading today. So it gives us an idea that if we look at the two-year Treasury, the market is kind of telling us that there's maybe one more Fed rate cut for this year planned, at least from the market's perspective. The Fed is saying probably two. Again, hard to tell which one way or another. Why is the Federal Reserve talking about cutting interest rates at all, since cutting interest rates would tend to put more upward pressure on inflation, particularly since inflation is around 3% already? It has to do with the jobs market. There's a lot of concern that unemployment is rising and the number of jobs being created is not enough to employ everyone who's interested in working. That itself in economic circles is a big topic of discussion. Unemployment right now at about 4.5%. It wasn't too long ago that it was understood that unemployment below 5% was unsustainable. The reality of it is we've had unemployment below 5% for a number of years now, and we've seen it before. So it is possible to have unemployment below 5% without creating a lot of inflation. Matter of fact, as unemployment was going down in the wake of the great financial crisis, right, we saw some of the lowest inflation out there. Yes, we've seen some inflation in the wake of the pandemic. A lot of that was the economic response to the way the pandemic was handled. That's beyond the scope of this conversation right now. But the reality of it is the Fed is looking at or considering lowering interest rate further, risking rising pressure on inflation because they see the unemployment market deteriorating some. We have a record number of people working, about 164 million people working, but this is what the Federal Reserve has their eye on. It's what we call non-farm payroll. New jobs being created continues to decline, and that in itself is kind of an alarming chart. But the reality of it is employment needs to be a matter of supply and demand. And if the supply of labor is not that strong, the supply of new jobs doesn't need to be that strong. And this is where the debate in economic circles is. Our birth-death rate in the United States, particularly with the baby boomers retiring, and I shouldn't call it birth-death, maybe I should call it retirement, going into retirement and then people coming into the workforce, is about a net zero, right? So to the extent that we have a net zero new supply of labor, chances are we probably only need a net zero supply of new jobs. The economic research think tanks look at a number of new jobs from negative 20,000 to positive 20,000 are probably adequate given the supply of labor entering and exiting the market. As I mentioned, that's a big debate. No one really knows what the answer to that question is, but that's the sum of Federal Reserve is looking at. Debt to GDP, you've probably heard a lot about federal debt. The numbers are large. As a matter of fact, historically, it's pretty normal for the federal government to deficit spend. That means spend more in the way of in excess of money being collected in taxes. Usually ends up being around 2% of GDP. You can see that we have been spending at a rate above that 2% deficit to GDP, really going back to the great financial crisis. There was a spike back in 2008, 2009, kind of tailed off, getting close back down to normal around 2015, 2016. really spiking in the wake of the pandemic, and then drifting back down to still showing deficit levels of somewhere around 5% of GDP. In terms of debt to GDP, which is a common way to measure it, you'll see a red and a blue line here. This is total federal debt, about $38.5 trillion versus GDP, gross domestic product, of $31 trillion. Prior to the great financial crisis, our overall federal debt was noticeably below GDP. You can see those lines laying on top of each other kind of in the wake of the great financial crisis, and then the lines really pushing out in the wake of the pandemic. Problem is, in the wake of the pandemic, that number has really never come back down, right? I mean, we're back arguably to a normal economic environment, but we continue to deficit spend at elevated levels, almost like we're in some sort of recessionary period. That is creating a big gap between debt and GDP. Debt to GDP numbers now are about 120%. There are other countries that sustain higher debt to GDP levels, but there's getting to be some concern. Japan's one of the highest developed countries in terms of debt to GDP. And if you follow the foreign markets at all, there's some concern about the prospect of Japanese longer-term debt. Those interest rates are rising as the market's trying to absorb the concept of their ability to pay it back at some point. Growth rate. Our domestic growth rate, gross domestic product, continues to push higher. You might be thinking, is there any positive news for the market in 2026? Absolutely. Our GDP continues to go up. Our productivity continues to go up. Lots of exciting new developments, mostly in the form of AI. Yes, AI is under pressure right now in the market and everything around AI, but that's the way things go from a development standpoint. If you read our 2026 annual outlook, there's some discussion in there and some examples of how other leading advances have materialized in the past and stories around that. So it's kind of interesting there. But yes, definitely GDP growth, still looking in that 2.5% range for 2026. Part of that's going to be supported by the new tax bill. Numbers suggest that tax refunds this year, because of the new tax bill pass, are somewhere around $150 billion. That's a lot of money going into the economy. So a lot of good things on the horizon. I should also mention that, in a capitalistic system like the United States, economic expansion usually does not die of old age. It doesn't all of a sudden, turn into a recession. Usually there's some sort of catalyst that creates that environment. The most recent one was the pandemic and housing crisis and the dot-com, tronics. I mean, there's all sorts of historical examples of unexpected events that change a trajectory, but they rarely die of old age. Last topic on my agenda is tariffs. And if you look at this screen, our tariff rate has gone from about 3%, give or take a little bit, all the way up to almost 11%. And, everyone's saying how it's going to create inflation. It's going to be a disaster for our economy. And what I thought I would do is add a little bit more perspective on the next graph. It shows tariff levels that other countries charge us to send things to them. So you can see China's at about 8%, Vietnam and Brazil touching 11.5%, South Korea 13%, India's all the way up to about 17%. Canada's a big trading partner of ours. I wasn't able to get that data. This comes from the World Trade Organization. Mexico about 7%, right? So that number you saw on the previous page is not that much different than what other countries charge us. So call it equalization of tariffs in terms of how they look on the global stage. Now, a better discussion for topic is why tariffs in the first place. In terms of our GDP, gross domestic product, that we were just talking about, is GDP is the culmination of us as consumers, which is about 2/3 of GDP. The products and services that we buy throughout the year is 2/3 or 66% of GDP. Business investment, and this is property, plant, and equipment, ends up being about 17% of GDP. And historically, the government spending is about 17% of GDP, but we saw on the previous pages that right now it's about 23% of GDP, so elevated. Those of you who are quick at math are saying, hey, Greg, look, 66 plus 17 plus 17, that's already 100%. The government spending, deficit spending at 5% makes that 105. What are you talking about? Your math is off. Well, there is one more component of GDP that goes into that calculation, and that is exports minus imports. Anything that we import that is in excess of what we export is a deduction from GDP. And prior to implementing these trade tariffs, our deficit was massive. Our trade deficit was massive. Here's a picture of what that looks like in terms of trade deficits. Just a few months ago, at the beginning of 2025, I think that was about April actually, we were importing 140 billion a month more than we were exporting. Well, that's a deduct from our GDP of about 5%, right? So to the extent that we could reduce that gap between our exports and imports, we improve our GDP. And you can see on that graph that the most recent number, the exports minus imports, we imported only $29 billion more than we exported. That has helped our GDP growth significantly. So there we have with our update for the first quarter 2025. A lot of positive things on the horizon. We'll start to figure out what AI means to us in terms of a productivity standpoint, tax refunds being larger than normal, potentially some declining interest rates from the Fed level. Hopefully that ends up being migrating throughout the yield curve where mortgage rates go down. That is yet to be seen. But thank you very much for joining us for this call. Hopefully it was informative. Wishing you a great day. Thanks now. Bye.